You know, what's funny about this business is people get all worked up about an inverted curve, but it's really not the inverted curve that gets you in trouble. It's when the curve begins to come out of inversion, when the curve actually starts to steepen. And I think the big story of the last 3-4 months is the steepening of 2s and 10s. Now, it's steepened in an odd way. This has been a bear steepener. So 10-year yields have backed up, even if 2s have kind of hovered around 5. It's a little unusual. You've only saw that twice historically, 1969, 1970, and 1973, 74. It was the signal you were approaching the tough part of the business cycle. And I think what's interesting, when you look at these steepeners historically, that move going from inverted back to positive has typically been the worst part of the equity cycle. So I just want to be mindful of what the signal here is. It tends to be a risk-off signal, particularly for leadership. And I think the big story the last 4, 5, 6 weeks is how you've seen cyclicality really start to falter and defensive showing some life.
So when you say the worst part, like how bad was that period in the equity markets for those 2 periods of time?
Yeah, I mean, that was the lead up to the recession in 69 and then 73, 74. So you're at the point where markets actually tend to be topping. The best part of the curve is actually when it's very, very steep and flattening. So there's misconceptions about the curve. It's when it's steepening from an inverted position, trouble has typically followed.
And there's an argument that this kind of bear steepening, which is the long end getting higher, is somewhat bullish because the economy's not falling out of bed and you're not seeing at least the market start to price in the short end of the curve. The part about this that just is different and feels different is that some of this steepening is all coming from supply. It's all coming from some dysfunction around our government, possibly, but certainly around refunding, certainly around the dynamic of where I think the global interest rate pattern is going higher. And look at the dollar, by the way, the dollar, which today went up to kissed that 106 level on the Dixie. You're basically, I think, breaking out through that March resistance. And you probably will test it. As someone that thought that the dollar was going to go lower, and I'm not alone, I think it's a crowded trade of people that have been, frankly, wrong about this dollar weakening. I think it's a very crowded trade that probably still will see people holding in there, but the dollar is painful for markets here, and I think that's going toe in toe with the Treasury market.
The warning signs are there. I mean, Chris is right. The reason why people get exorcised about an inverted yield curve is because they know at some point it's going to re-steepen, and to your point, the re-steepening is when things get dicey. And this bear re-steepening, again, not to get too wonky, it's happening in a very dramatic way. I mean, 10-year yields now through 4.5%. This is the highest we've seen in 16 years. The TLT closing below 90. Not a good thing either. And you have to wonder, how long can the market hold in there? The S&P has held last August high, 4330-ish. We've bounced off there a couple times. That's a good sign. The question is for how much longer.
Yeah, it's interesting that Chris mentioned what this means for this stage of the economic cycle. And I'm just like two of my favorite bears on the street, Mike Wilson at Morgan Stanley. He's talking about just consumer and some of the data that they're tracking and what that means. And then Marko Kolanovic over at JP Morgan this morning, also in a note out, just talking about corporates' ability to pass through this same kind of concept, pass through, higher input costs and the like. And you just say to yourself, as it relates to the economy, we have businesses that probably hit peak margins and have, really pass through as much as they can. And a consumer, from a credit standpoint, that's just tapped at a point where rates have gone up so fast. And if you are like a lower wage earner and wages have, at least the pace in which they're going up has decelerated a little bit, I'm just hard pressed to see all of this together is conducive for equities going much higher in the near term until there's a proper correction or so. And if you look at that equal weight S&P 500, it was about down 9% or so. I think like seeing down 10% would be an interesting alarm bell with the VIX above 20 or something. We haven't gotten there yet, but it might get there, especially if we have a continuation of this move where the 10-year keeps going higher and we have that re-steepening.